Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another Planning for Life podcast. Today we are talking to Carl Coolidge, and we're going to talk about common finance myths. Now, Carl, these are things that I've heard and done some research on. Some of them might seem a little bit surprising that people still think this way, but being a financial services professional and doing it for as long as you have, I just thought these would be kind of fun to ask you and see what your opinions are on them.
Okay, fantastic.
The first one is, I think I'm going to go in order of ridiculousness. I'll make less money if I get a raise into a higher tax bracket. What do you think?
I don't think it's ever a bad thing when you can make more money. You know, it's always that catch-22, just like we talk about with people who have appreciated stock. They don't want to sell it because they don't want to pay the capital gains tax, but they don't want to sell it when they're down because they don't want to lose money. You can't have it both ways. So I think, yes, if you can certainly have additional income, even though you may pay some additional tax, what I've typically seen is the net is higher, not lower.
You've talked about this on podcasts before with 401ks. Take that money, and if you can add it to your 401k, that way you're not going to see a higher tax bracket anyway, right? Because you're going to be in the same tax bracket because that's tax deferred, correct?
Correct. And that's why we talk to a lot of participants with our 401k plans about doing a percentage of your income versus a dollar amount, because when you have that increase, then it automatically goes up.
Yeah.
You're not having, you're not withholding $100 a month. You're withholding 6% of your pay. So when you do get those increases, it's an automatic tool to continue to save more.
Now, is that a plan standard? Every time I've had a 401k in my life, it was always a percentage. Do you have that choice when you're enrolling?
Usually most plans will allow you to do either. It's almost more a function of payroll, what they're comfortable with. We encourage heavily always to do percentages when we're doing our education enrollments, but you will have some people that operate better when they can do X dollars per paycheck. But I think we encourage them to do the other way from a percentage standpoint for the reasons I mentioned. So probably 98% of ours are percentage and probably 2% do a dollar amount, just because they can compute it better in their head how it's going to affect their check.
Next one. Renting is a waste of money.
Yes, this one goes way back, right, of what is the best option. And it does depend on factors. I will say that you look at a lot of studies and your biggest investment is your home, right? That's what they say for everyone. When you factor in the mortgage interest deduction, the likely appreciation, owning probably does outweigh renting, although they did change the tax law, a few years ago about the amount of mortgage interest you can deduct. So that does have an impact on it. But renting in the right situations, I think, can make a lot of sense. So example, I'll have clients when they retire and they want to move to a new location. A lot of times that's either a resort type community where they can have that high end restaurants and other things that they can do in retirement, or it's related to being closer to their children or grandchildren, really is what it's more about. I will encourage them to look at renting for 6 months or a year to make sure that's really what they wanted to do, because it sounds good on paper, but until you get there, begin to live your lifestyle, you want to make sure it really makes sense. So that's where I think renting versus owning can have its merits. It just depends on your situation, like a lot of things with your financial picture.
The next one is wildly relevant to where we are right now, which is I should get out of the stock market when it's doing poorly.
Again, I've had this conversation a few hundred times lately. Really what it boils down to is people have the emotions that they need to make this happen versus what logically makes sense. And emotions, of course, drive a lot of things in our lives, if not all things in our lives. So, by nature, when you see your account going down, or from an emotional standpoint, you think, hey, I need to get out of this before it gets so bad that I have no money. If you look on paper and you said to most people, you should buy high, or excuse me, buy low and sell high, they would agree, but their emotions don't allow them to do that. So that's really one of our major roles, is to bring some logical awareness, some common sense, some comfort to their emotions, that we have a lot of history, we have a lot of data to support that if you can stay in and survive the ups and downs, that you, generally speaking, come out in a better place than you were if you totally got out of the market. So it's really about your personal situation and making sure it fits into your overall financial plan. So go back to, why did you invest this way to begin with? What is this money really used for? Think about all of those things that are important and factor into how this is going to affect you over the long term.
How about I don't need to save for retirement yet?
I would say that's a huge myth, because time is something you can't get back. So I have this conversation quite a bit with younger individuals, and when I say younger, even into their early 40s, that time is not something you can go back and get. You can save more money as you make more income, but there's nothing to replace that time factor. So the key is, when you begin working, for those younger people listening, you want to begin saving some amount of money, whatever that may be. And it can be 1, 2, 3% of your income. But what we found is, if you start saving from the beginning, then you generally do not stop saving. So going back to what we originally talked about, if you're saving on a percentage basis, as your income increases, then your contributions will incrementally increase. So it's really, time is on your side when you're younger. As you get older, you can't make up that time. And there's plenty of charts you can Google to say, if I save X dollars when I'm 25 and I save the same money when I'm 45, the amount difference of money that you have at retirement, or also what it'll take to get the same amount of money at retirement. Time is really, 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 did I say really, Matt?
Just a
Really
few
your
times.
friend when it comes to investing.
Cash is king.
Well, cash is certainly always beneficial to have, where it fits into your situation. And what I mean by that is, we focus a lot in our planning on having the proper amount of emergency reserves. You can look at a lot of different stats, but that's typically 3 to 6 months of your expenses. So I think having that amount of money put away is important. So when we're dealing with times like now, especially, you have that cushion, where if your income decreases, or if you're on some sort of bonus compensation structure, and that may not be as strong over the coming quarters, this gives you some cushion to do that. So why I think is important to have cash. King may be a little strong, because cash does not really produce long-term opportunities for you from a performance standpoint. Finding the right amount of cash to keep versus investing it is really an individual conversation, but it's very important to find that balance, because too much cash is not working for you long term.
How about I don't need to worry about money if my partner or someone else manages it?
I think it's always important to have knowledge of what's going on in your financial household. And as I tell a lot of clients, everyone has their specialties, right? So at my house, if the internet goes down or there's some issue with our provider, it's suddenly my issue, right? Because I'm clearly a internet IT tech person. So my kids, my wife say automatically, you've got to deal with that. So I'm sure at everyone's household, there are certain things that people deal with that are viewed as your job, whether they are or aren't. So I see a lot of spouses that one will handle the finances, one typically does not. But I do think it's important, and we tie this in through our financial planning, where the spouse becomes involved with that process so they understand exactly what's going on from not only a bill paying standpoint, but if there's multiple properties or if there's multiple accounts, different investment accounts. I think it's very important that there's at least the knowledge base there so they know that it exists. And that's really what we're able to tie in with our planning. So I encourage everyone to, even if you don't have interest in it, at least make yourself aware of it.
Next, I don't need an emergency fund.
Well, we touched on this before, and I do think there's some wrinkles, if you will, to having an emergency fund, because if you don't believe cash is king, or you shouldn't have an over abundance of cash, then I think you can find emergency reserves in a couple of different ways. And what I mean by that is cash is certainly one, the 3 to 6 months of expenses that we referenced earlier. Two can be if you have lines of credit, say a home equity line of credit that's not exercised, but just available. That is access to emergency funds if you need it. Now, granted, that becomes a loan, but it is accessible in the event of an emergency. And again, depending on what your interest rate is on that, it can be a good option. You also have access if you've built up money in your retirement plans that have loans. Again, it's in the form of a loan, but if you needed emergency funds, they are available. I think that's the key, is really looking at your situation to say, okay, how does this really fit in? Do I need 3 to 6 months? Probably, but if I have 3 months of cash, can I get those other 3 months through some sort of short-term expensive loan or a home equity line of credit or whatever it may be? Then it may fit for your situation. It just really depends. But absolutely, the foundation of any financial plan is having your emergency reserves accessible, because again, times like now are really showing us exactly why they are a necessity.
Having a credit balance will boost your credit score.
No, having credit that is current will boost your credit score. You want to focus on making timely payments, and how banks and credit card companies look at your credit, and this be for a traditional loan or a credit card or whatever it may be, is the balance that you have accessible. That's what they count. They don't. So if you have a credit card that has a $10,000 credit line, but you only have 5,000 on it, they look at the 10,000 as your exposure. So your balance does matter to some degree, but it's really more important about making sure you're making consistent payments on time, and they're looking at that larger credit line, if you will, not the actual balance.
Along those lines, all debt is bad.
Absolutely not. We have this conversation quite a bit with our clients, and there's certainly debt that is bad. Credit card debt leads the way, is if you don't pay it off on a monthly basis because the interest rates are so high. I would say home debt, generally speaking, can be very good debt, because it's not only a usable asset, typically an appreciating asset, but very few people can write a check for their house, because as we referenced earlier, it's your largest investment that most people will ever make. I think it's crucial to have some of those debts, and they can give you some additional protections from a liability standpoint, which is, works for certain people. But I think having the proper liabilities can make a lot of sense if they're managed correctly, fit into your overall financial situation. And cars are the last one I'd say that we get a lot of questions about. And that's a really tricky one because cars are a necessity and you want a reliable vehicle. And as we know, cars aren't inexpensive anymore. I think having that kind of debt is one of those hybrid. It can be good, it can be bad. It just depends on how it's structured.
Price equals quality for stocks, for goods, those sorts of things.
Well, I think that certainly we all have biases to things that we believe you pay a premium price for because we feel like they're better or more efficient than certain other name brands. And I mean, that's what's built America, right? Certain people buy brands that may be the equivalent to what someone else has, but they built up that brand name recognition. So I don't think price equals quality. I think in some cases we are willing to pay up for quality because we believe that it is a better product than some others. And I won't get into specifics, but certainly there are things that I think personally that makes sense to pay up for the quality. But that's something that really each individual has to decide. And probably the most notorious is, when you look at a product like a Tylenol and you can buy the CVS, Walgreens, whatever it may be, off brand. And if you look at the ingredients, it's exactly the same, but some people will pay for the Tylenol and pay a premium for that versus the other off brand because they just believe or have more comfort in that. Does price equal quality there? If you look at based on purely the ingredients, no, it's the same thing. But if it gives you that sense of comfort, then maybe it's something you do.
What about from an investment standpoint? Now, I'm not asking you to give, investment advice here, but there are people who would say, $1,000 stock is a higher quality stock than a $50 stock.
No, I think that's all dependent upon what their balance sheets look like. Stocks split all the time, so sometimes that can affect the stock price. But certainly, just because a stock is an expensive number, like you say, a higher per share value, doesn't mean it's a higher quality company than say another company. There are such things as investments that are what they call penny stocks, which certainly generally speaking are more aggressive because they may or may not make it long term and their values are much lower, cents per share versus dollars per share. But I would say just because something is a higher price doesn't necessarily mean it's not as valuable as something lower priced. You have to look at the numbers behind that to really see what is causing that stock price to be so high or low, depending on the company.
The stock market is too risky. How about that one?
Well, it certainly can be depending on how you invest in it. I mean, it's all about your risk tolerance and how it fits into your overall plan. And a lot of people do feel uncomfortable with the market because no one can fully understand it. And I think I've talked about this on other podcasts. Even people who eat, breathe, sleep the markets never can fully understand it because some days you'll have data that should support the markets going up and it acts the opposite. So there's no good rhyme or reason to it sometimes. I think the key is we've gotten enough history in the market to show that if you stay invested, stay focused, know your risk tolerance, know how it works into your plan, then you generally come out in a better place than if you didn't invest in it. Past performance is no indication of future results, as they say, but it can be risky, but you just have to understand your risk tolerance and how it fits into your financial plan and make sure you continually monitor that so it really is in line with what you want it to be and what you originally purchased it for.
Now, my last question for you today, Carl, is it's impossible to know how much I'll need in retirement.
That's a huge myth. There are a lot of tools that are available, but I would say selfishly, find a good financial planner and go through that process so you can clearly understand how much you will need for the various items. And we're talking about retirement here, but what you're going to need in order to be successful in retirement. So it's very easy to quantify those numbers. Yes, you have to do some work as it relates to your expenses, gathering all of your data, but if you put in good information, you're going to receive good information back. So there's definitely ways that you can understand clearly what you're going to need in retirement, what that's going to look like to meet not only your goals and not only your needs, but your wants and the other things you may want to experience in retirement.
Well, Carl, thank you very much for walking us through some of these myths today. I know that you hear these probably more often than anybody, being a professional financial advisor. It's a good opportunity for your audience to share this podcast with people who they've probably had conversations about these myths specifically. So, Carl, thanks so much for being on the show today.
Thanks, Matt.
If you have not subscribed to the podcast, make sure you do. And if you do know anybody who has talked to you about some of these weird myths surrounding some financial decisions, please make sure that you just share it. It's super easy. So for Russell Jacobs and Carl Coolidge, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs, Coolidge & Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.